Welcome to the Pathfinder Legacy Podcast, where we help farmers, ranchers, and business owners create a seamless transition plan for the future. From retirement to ownership transfer, we protect what you've built and guide you every step of the way.
Hello, all. Welcome back to the Pathfinder Legacy Podcast, where farm families turn hard conversations into real plans. I'm your host, Heidi Olson. We're in the last half of September for Life Insurance Awareness Month, and today we're getting practical about how life insurance dollars move when something happens, who should own the policy, who should receive the funds, and how to route it through your trusts and entities so it pays the right bills at the right time. What I'm talking about today is not glamorous. It's not date night material, but it's keep the family together material. Before we talk products, we need to look at three important factors. If you can answer these three, you're ahead of 90% of the operators. Purpose. What is the purpose of this policy? What bill does it pay? Does it pay buy-sell purchase agreements, contract for deed, balancing inheritance, or paying land notes and operating notes? Who's the ownership and payor? Who pays the premium? Is it paying an individual, LLC, or a trust? And beneficiary routing. Where did the dollars land first? To a trust that then pays off farm children? To the LLC to pay off partners? Choose the path that best matches the bill. The most expensive policy is the one that pays the wrong person at the wrong time. Do you want the money paid to a spouse that wasn't meant to have control of the funds? Are there outside influences, such as adult children or friends begging for money? I like to call them the vultures. Will the policy affect long-term care benefits, or do you have minor children that need to be taken care of? Giving them funds outright or directly to a guardian to manage could be a disaster. This is where a trust would step in to keep finances separate from the temptations of guardians or minor children while keeping them accountable for the distributions. Is it really a need or a want? Two neighbors, the Larson family, they had a plan. If dad passed, a policy would send cash to the family plan bucket first, where the trustee knew exactly what bills to pay: funeral costs, fuel, and a little cushion for living. The on-farm daughter kept harvesting and everyone ate supper together. The Smith family also had insurance, but it paid straight to mom. Mom never did the books, so she had no instructions, no timing of what to pay and when. Now mom had to decide what to fund first while she was still grieving. The kids got nervous and the equipment payment slipped. A field sat a week with no work being done. This was a decent policy, but the wrong pocket at the wrong time. Why does this make a policy expensive, even if the premium was cheap? It breaks the plan that you had originally designed. The policy names your spouse directly, but your equalization plan needed the trust to receive and schedule payouts to off-farm children. This resulted in family conflict and a scramble to fix things with cash you no longer control. It also can create taxes or delays you didn't expect. Naming the estate as a beneficiary can drag dollars through probate, costing you delays and legal fees. Now, keep in mind, if you are single, have no children, there's no reason why you can't add your estate as a beneficiary, because at the end of the day, there's nobody waiting for those funds at the end. Keeping incidents of ownership can pull proceeds into the taxable estate when size matters. All right. The Goodman Triangle is when the owner, insured, and beneficiary are three different people. At death, the IRS treats the payout like the owner just made a gift to the beneficiary. Keep the owner and beneficiaries aligned or use a trust to avoid creating a gift tax issue at the finish line. It starts operations when liquidity is needed most. If the bank is absolutely assigned to the policy or the beneficiary is misrouted, dollars don't land in the operating account to cover inputs or mortgage payments. You may be forced to sell equipment or farmland at the worst time, or you have a policy that simply isn't there. Term insurance has expired. The premium lapsed or the face amount was never updated after land doubled in value. Coverage that doesn't match reality is a hidden liability. A family that I worked with, who each spouse owned their own life insurance policies. These policies were designed to keep their family business going after they passed. Dad was 82 and paid over $450,000 during his lifetime. Now that he was aging, the policy became more expensive. The annual premiums grew to over $150,000 per year. He needed to continue paying the higher premiums to keep the death benefit and keep the policy living. If he didn't pay the higher premiums, the policy would have eventually termed out. He decided to let the policy lapse since he could no longer afford the increase in premiums. Assignment 8, the buy-sell. This isn't a story about your dog eating your homework, but close. So a policy was fully assigned to the lender when a partner died. Proceeds went to pay the loan, but the LLC had no cash to buy the widow's shares. They had to borrow at high rates or sell equipment to complete the buyout. Let's meet the Johnson family. 3 kids, 1 on the farm, 2 off. Mom and dad wanted everyone treated fairly without splitting up the acres. They kept it simple in their eyes. The farm goes to the on-farm kid. A life insurance policy lands in the family plan folder first. The instructions say off-farm kids each get X amount of dollars from this policy, paid over 2 years so we don't choke cash flow. They were all able to continue sitting at the same table for Thanksgiving. No for sale signs needed here. The off-farm kids got cash and the on-farm kid got a workable operation. That's what a real plan looks like. Documents must agree with the dollars. Here are the fast fixes that prevent those 2 a.m. phone calls. Trust language, must do what you want. Beneficiaries versus transfer on death. Make sure the money goes where it's supposed to. Policy checkups. Put policy summaries, ownership, riders, and review dates in your estate binder and make sure you're looking at them every time that there is a life change, or at least every 5 years. Every farm has an Aunt Linda. Maybe not your aunt, but you know the one. She runs payroll, pays the bills, talks to the salesman, and knows where everything is. One family I was working with lost their Aunt Linda. A small policy on her life sent money to the farm account. Those funds bought time. They hired a temporary bookkeeper, paid for extra hours, and got a consultant to rebuild the books. Was it glamorous? Nope, but it did the job. It kept the wheels running, and life moved on for that family. Life insurance doesn't bring people back, but it does buy you time and cash flow options. Last fall, I met a family certain they had insurance. They had everything they needed. It was a good-sized policy naming mom directly. The plan, however, called for distributing to the trust instead of to mom. We made sure the beneficiary was changed and added a small-term rider to cover new equipment debt. Same premiums, but a different outcome. We avoided a disaster with that one. All right, I'm going to derail for a minute. On another side note of insurance, I know of a couple who paid a premium for 40 years for long-term care insurance. But what was it paying for 40 years ago would barely cover medications today. This policy did not have a cost of living increase. Be sure you're also watching for that on your policies. All right, grab the policy ownership and beneficiary map in the show notes. Next week, I'm going to be discussing questions from our mailbag. If you can't fill in the blanks on today's toolbox tip, tell me where you're stuck. Drop your farm planning questions in an email to me at heidi@pathfinderlegacy.com. My role as a succession planner is overseeing the team, ensuring the attorney, CPA, insurance agent, and trustee align on the why. As the air traffic controller, I'm not selling the policy. I make sure the dollars are in the right account at the right time. This is education, not legal or tax advice. I will work with your team to make sure your needs match up with your business plan. At the end of the day, the right policy puts dollars in the right bucket at the right time. So your plan, not panic, decides. See you next week for the Mailbag episode. Thanks for joining me on the Pathfinder Legacy podcast. If you found today's episode helpful, share it with a friend or business farm family. And if you're ready to start the conversation, let's talk. Book a 30-minute discovery call. You can connect with me at pathfinderlegacy.com. Until next time, I'll see you between the ditches.
Thanks for listening to the Pathfinder Legacy Podcast, where your future is our focus. Be sure to subscribe, follow us on social media, and visit us at pathfinderlegacy.com to start building your transition plan today.